Alright, hello guys, and glad to have you on board again today. You might hear it for the sound of my voice. I have caught some nasty stuff once again. Don't worry, I'll get over it. But the thing is that, well, I try to make it as quickly as possible, but there are plenty of things that I wish I'd had more time to talk about, because there's been hell of some external catalysts and volatility over the latest few days. And in that perspective, well, I've made the update for what I think it's going to happen out of it on the longer time frames, aka not so much new things to me, because it's no more than just confirming the stagflation is likely inevitable. But TLDR in here is that, well, in the short run, whatever it happened in here has implication on any of the lower time frame flow trading that we're generally talking about in those Wednesday sessions. So it's been very complicated to navigate, and this isn't the first time. Remember that over the course of the latest weeks, as we do those regular updates, we've mentioned the fact that for the S&P 500, there was one very tricky area to navigate, which is particularly this one, due to the fact that I could hardly say if whether or not this was the third flow, and if all this volatility that happened in here, and specifically this third range boundary, was enough to be considered the end of the flow, or if it was just yet another trap that we will get through very quickly. Well, it turns out now we've got the clear answer out of it. It's very, very neat. We've definitely had 1, 2, 3 flows, and now's the time for the 2 consecutive consolidation flows that we have mentioned back then. This is basically in front of you the number one cheat sheet of how volatility is played by the market makers. So of course, remember that what you need to learn out of this is not how this exact pattern played out and how you can replicate it on every other asset. It doesn't work out that way. What you need to figure out is the structure. Looking out through the lenses of your indicators, how does this thing play out in this market, and how exactly similar to this behavior will be on other assets. But the variables will be just how fast and how long these flows will go, and this will vary significantly from asset to asset. So the only way you can navigate this volatility is by having a set of rules to frame it, aka the flow trading strategy. So you only go for 3 sets of flows in a single sequence, and then you're going to have to let the opposites go for 2 consecutive consolidation flows before you're going to be able to start all over again. Okay, so TLDR is that right now we've got the full sequence, 1, 2, 3, and the first and second consecutive flow. And we're currently going for the second one, which means by the end of this one, and we've talked about that before, so this shouldn't be new, once this second flow terminates, we should have the beginning of a first flow, which will just replicate the same sequence all over again. Okay, and don't copy paste the previous prices, because things will vary, both in duration and in amplitude. Okay, remember that a flow doesn't necessarily have to last that long. Okay, a flow can last double the amount of time. It just waits, and it just requires for you to wait to get a third range boundary. As long as you don't get any, you just have to let yourself go with it. Okay, and some flows will go vertical, like we've seen, for example, when the cryptos broke out of the bear trend and alike. That's really the way it is. Okay, don't try to control, don't copy paste, just look for the overall structure. First flow, second flow, intermediate consolidation has been very, very, very fast, dramatically fast actually, but enough to reverse the context. It's just that way, of course, we've had an external catalyst that has pushed prices right back down, triggering the second flow immediately right after. The second flow, like we stated, had to break the previous low point, which we did. So now the second flow is going on full force, and on top of it, we've got a volatility alert on the higher time frame, which means, well, I think we should pay attention to these numbers. And the thing is that, well, what I've seen now in some market participants, quite the opposite. Some of them are getting extremely aggressive, like, yeah, this was the opportunity of a lifetime, whatever. Now that the things have cracked, there's only going to be the Fed pivots or whatever bullshit, and now it's just up only. Well, like I said, it's complicated. Stagflation is definitely not an easy environment to navigate. It's going to take time for trends to emerge because we're very likely going to last almost 2 years in this environment. And it isn't going to be an easy thing, because definitely not the kind of market in which everything goes up. It's not that way, okay? There's going to be a choppy market for broad indices like the S&P 500, because some sectors will go down hard when some others will pump hard, and the overall net is still slightly positive, but certainly not looking like the previous trends, not the things like the 2020s and the like, okay? So the flows will likely be hashed up like it was like that, okay? So choppy markets are expected. Moreover, when you get the volatility alerts, instead of just getting more aggressive, you should really be smarter than that and say, well, okay, maybe I should step down a bit, and eventually assess that maybe, just maybe, putting some stop losses away would be a smarter choice, which is exactly what I've done. So remember, I had a lot of uncertainty, therefore I decided not to take my profits out there. I took some partial profits still, but the thing is that I decided to take the risk of eventually being proven wrong and see all my gains being flushed out by the market. That's exactly what happened. Just because, well, I didn't know. I also assessed the fact that the market could just rise up again, fuck up the third range boundary, and trigger the flow to get right up to my targets. And in that perspective, well, I would have been the dumbest person to profit take right before the actual pump. So no one ever knew, and neither did I. The thing is that I've always made it clear, if it goes on the opposite direction, I'll do what I do best, which means I will risk manage. Some of my trades will be stopped at break even. That's too bad, but that's also something that happens. And the second thing is that I'm going to wait for the 2 consecutive bear flows in order to actually go buying again, which is exactly what I do now. I had some bullish trades in here with an average entry price. I think right now my entry price is slightly lower than 4,000, something like that. And in that perspective, well, regarding these new volatility alerts, the only decision that I decided to take, and that's a money management decision, and there are many ways in which other traders would have taken other choices. The thing is that as long as it respects my rules, I'm fine with that. My choice in here is that I have a binary choice. Either I decide to get out, I take my profits or losses, and I will say, okay, now the second flow is in, and I don't know where it's going. I'm just going to let it be, and I'm going to wait for the first flow, and then I'm going to buy again, okay? Which means I'm going to wait for the second bear flow to terminate itself. I'm not going to try to forecast any of the potential targets. Remember, flow trading have different structures, and they can last as long as they want to until you get a third range boundary. So this is the first option. I could wait for it to reverse and create a third range boundary to eventually try to buy it. Second option, I let it terminate itself, not trying to anticipate anything. I'm going to wait for a first bullish flow to emerge, just like this one. I wouldn't trade it, and I would buy after this one terminates and starts to retrace. These are the options that I have available, okay? So as you can see in here, I think net, all of this is kind of very averaging around this 4,000 level, which is, once again, the mid area of the big fucking range which we're in, which means the massive support is 3,800, the massive resistance 4,200, and 4,000 is kind of the middle ground. So I have kind of average prices, which means I've made average decisions. My job is to be the best possible I can, but the thing is that turns out in here I was wrong, and I'm stuck with an average price. So I can do everything I want. I can just say, yeah, average decision, I would like to get out, and I'll go back in again at a better price. Or option number 2, this is fucking choppy, I don't know, and I'm certainly not going to get out. I'm still trading in the right direction, because for now on and until proven wrong, the low risk strategies that have been triggered on the weekly time frames still have triggered upflows. They terminated the sequence, and even though I wished the sequence which would have been better or more profitable for me, well, turns out we decided to go the other way around. The bears are now having their 2 consecutive consolidation cycles, and once they terminated it, the bulls will take over again. So that's really the way it is. I don't think there's any reason for me to change my course. It's just that, well, I've got wrong-footed by the timings. It happened in the past, it happens and will happen in the future. That's really the way it is. I just don't control, and I'm not looking for control. Though multiple choices were offered to me. Like I said, either I decide to get out, take profits or losses, just try to exit the trade as much as I can, and I will re-enter again on more favorable wins. Option number 2 is, well, regarding on the position sizing, do I have the luxury to push my stop losses away? Remember that my previous stop losses were below this previous low because I was trading on a flow sequence, meaning I want to have higher lows and high highs. The thing is that, well, now with this volatility alert, I can be very well sure that there are significant probabilities for the market to trade below those prices, which is exactly what I don't want. I don't want to be stopped at the lows. So the thing is that choice that I have is either I get out and I'll get back in again, or I stay in, but I have to widen the stop loss. If I want to do this option number 2, which is the one that I had chosen for, which is, well, okay, I'm going to stop flow trading for a little while. I still have positions in the market in the side of the low risk strategy. I'm going to stop trying to catch the bottom because I have average prices and I can hardly lower my average price now. So I'm just going to let the volatility play itself. The second flow terminates. I won't be able to buy the lows because I can't reinforce my position now, but I can widen the stop loss. Due to the fact that I have tiny position sizing, I was able to double the stop loss at a very low cost. I had 1.5% stop loss, 1.5% capital stop loss, which means I was able to double it and I'll only risk 3%. This is something that I accept doing, which also means their second rule in here is that according to the target area, which is 4,500, I still need to be somewhere in at least a 1-to-1 ratio. I don't want to risk more than I will willing to gain. So in this particular context, this is the only reason why I have the kind of context in which I can take my stop losses further down the line, which means I double the stop loss only if I haven't taken enough risk, meaning that if I were already down the line of 2% risk taken, I wouldn't risk 4% stop loss. 3% is kind of, yeah, it's bigger than the average 2% that I'm willing to take, but I'm willing to handle it. Of course, I never do this if my target is now further away than a 1-to-1 ratio of the stop that I move it to. Though in this rare context, I moved it. Moreover, the stop loss is put it out of the weekly risk management, which means if the market ever goes there, I'm not only going to take my stop loss, but I'm also going to have to review the entire long-term strategy, which means if we go right back down to the weekly support, that means I am not in the appropriate time frame. This could happen. Like I said, I don't know the future, and I'd like to make it straightforward, guys, okay? If you are blindly following someone on the social medias because you feel confident enough to say, I know the future, don't ever do that. These guys are gurus. I never will. I don't know the future, and I risk manage only, okay? So until then, all the proofs to me still stand that the bears are going to have 2 sets of corrective waves, and then the bulls will take over again, and they will get to the same old target. That the thing is just we're going to go there in a different way. If you were too stupid to go all in right there, you've been stopped and now proven wrong. So this is not how market works. They manipulate emotions and do everything they can to just prove you wrong. Until then, if you can navigate volatility efficiently, remember of your fear of uncertainty biases and your impatience biases, which means you can't control where prices are going and when the flow will end, and you can't control how long they last. So you have to be real patient. The only thing that replicates over time is the structure, okay? So until further notice, as long as this flow is going bear, I am not bullish. I'm going to wait for it to terminate, and the only way it can terminate is when I'll find a third range boundary. So H1 time frame, okay, is my reference. We're going down, okay? We've broken the previous low, so the flow is on full force. The only thing that can happen now is either we go higher, and then we're going to have to take and maintain a third range boundary, which means I want to see the market rebouncing out of it, and that will be the end of this flow. Option number 2, we keep on going lower and lower until we find this third range boundary and the like. Okay, so this flow can go on for as long as it wants to. You have no control over the duration. It's going to be uncomfortable to be in that situation, but that's the way it is. All right, so I told you what I do for transparency purposes. My choice has been, okay, I don't have any control over the current situation. It's messy to say the least. I don't know the outcomes. No one actually does. And all of those who pretend to are just absolute scammers. So in that sense, I decided to go humble. Take a step back and to say, well, I have positions in the market. They are at a pretty average price. And well, I just don't think I'm in the wrong direction. I just think the market from now on might want to go lower. It might already be done. There are reasonable probabilities in which what happened last week is the bottom. There are several chances for this to be. But the thing is that until then, well, I don't want to be making early calls on this. I just will look at the show from the distance, not pay attention to volatility because my position sizing are accordingly good. And in that sense, well, I'm fine with whatever happens within the next few weeks. Though I'm no longer flow trading, as long as this bearish flow is going on. I wish the bears good luck to push prices as low as they can. Once they terminated their job, it's going to be my time again. And until then, well, I'm just going to do nothing. I know it can sound stupid to say so, because on the other hand, if you look at the social medias and the like, all you'll see is people posting a shitload of activity and trading activity within the latest 72 hours, and to say, oh, look how great I was, look how much gains I made, and the like. Jesus Christ. I mean, with a bit of experience that I have, and I'm certainly not the most experienced trader out there, but the thing is that out of more than 10 years trading in the market, I've seen those patterns repeating endless numbers of times. Most of the times, these guys have less than 2 years of experience in the market. Just look at how much history they have on their Twitter account or whichever social media they're talking with. The thing is, most of the time, these guys don't last. They come and go, and I've seen them doing it over and over again. Instead, the true traders, the ones that were there 10 years back then and still there today, well, they don't do that kind of things. They really don't do it. So try to be smarter than that. Try to see through the noise. Try to look at the distance on if you're trying to learn how to trade, this is the way to do. All right? So I think right now, instead of going aggressive or whatever, it's just an appropriate time to say, okay, maybe the market's going to be volatile. I just don't want to be caught in between. You might be a short-term trader, but this is not what we do here. Remember that the day traders, I don't know many of them. I've been there before, and this is not a sustainable job. I said it before, and I say it again. I know very few day traders who successfully do it for years, okay? I know some that do it very well for a couple of years, 3 to 4 years at best. That's what I've done. But then sooner or later, you're going to have to make enough money, and you're going to have to switch to lower risk strategies. Just because, well, if you're trading intraday, you're going to be margin trading all over the place, and it just takes one day to fuck it all up. Remember that low risk strategies have one thing that intraday traders will never be able to get. That's the certainty that you own something. And like I've always said, heading into the dangerous years that we go through right now and the years that we'll be through to the next few years, you rather like to own something. That's really the way it is, all right? So I've always said, look at the distance. The only thing you can do if you trade volatility and intraday trade is to constitute capital so that later down the line, you will be able to trade lower risk strategies. That's what every professional trader is actually doing. And if you start down the line and if you don't have enough capital for low risk strategies, well, go for flow trading and stuff like that. But understand that this is always a limited time offer. Markets are volatile and prices can go infinite or zero on any assets. And if you were leveraged on this asset at that time, you will lose it all. That's really the way it is, folks. Okay? So try to be safe, try to be smart, and try to diversify. Okay? That's really the last thing. And right now, you've got plenty of opportunity to diversify. There are flow tradings that are going to start in the metals, silver, gold, whatever, okay? These are on different time frames. Always remember that if you copy paste and if you do some nasty shortcuts in your trading decisions, not going to work. All the time, slow down and do some regular analysis. Zoom the fuck out to try figuring out where the low risk is, because any decision you make should start with this. So if you look at silver, for example, same old story. The lowest strategy would be in here or even the higher time frame, but at least that is a quarterly or annually range. So this is kind of a large shit, okay? Though once you figured out the right time frame, which I would say is quali in here with a big cup and handle, which is a very rare structure, you would figure out, well, this thing is therefore going to flow trade 3 time frames below. So daily chart is where I should be able to see flow trading. Well, that's the same thing. This is where you can margin trade, okay? First flow, which means, hey, congratulations, you are in looking at the beginning of a second flow. Third range boundary has been plotted in here, which means you could buy there, and there, and there, and there, and there. Okay, that was really an easy trade to make, okay? You buy the Bollinger Band. Now, where does the next step goes? Same story, okay? We have made a nice up move and a strong consolidation. Everyone was bull, bear, bear, bull, 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 bear. I'm just personally not giving too much attention. I've just been loading hell a lot of this thing, waiting for the third range boundary to be broken. Next step to me is going out there and breaking up this third range boundary. If we do so, then the flow will trigger when we'll break the $30 mark. So that's really the way it is. And as you can see, this has nothing to do with the S&P 500. This also has nothing to do with all of the other flow trading that I do, for example, in the cryptos. Still, this is the same set of rules, the same framework that you apply over and over again. And those flow will have always different ways to put themselves in the market. Some will be very violent and brutal like this one, and you're going to feel like FOMOing in or out. But the thing is that as long as you have a set of rules that tells you what you need to do or what you can and can't do, well, you will be much better off than just randomly trying to follow influences over the internet. All right? So that's really the way it is. You can pick your own favorite assets. There is really an endless possible choices in here. Try to find out the quality ones and the liquid ones, but right now there are plenty of asset classes that are going to be interesting. I told you my personal favorite, the metals. I'm now starting to get interested in WTI as well, which I should be putting at bullish. There are plenty of asset classes with interest. The cryptos are very interesting. Now that we have the outcome of it, I would tend to say that we now have the resolution. I was back then confused about this expanding wedge kind of structure, saying, well, I don't think this is the third flow for cryptos. I was like, yeah, this could be the third flow, but I doubt it is. In order to see it happening, I need to see a third range boundary being traded, okay? I need to see lower highs and lower lows. And well, we just fucked up that structure because we've made a new high. So that's the same old story to me. I don't know what it is. It's a very harsh and difficult situation to figure out what this thing is. All we can say is that there was a first flow, there is a second, very aggressive, and like I said, this one was very excessive. So don't try to be aggressive again. Just understand that on this opposite direction, we might see volatility starting to rise back up again. And I would say that what we're in now is the third flow. Okay, so first, second, and third flow is now going on for cryptos. And I will be on that flow as long as it is. All right? When this flow terminates, and I don't know how far it will go, same old story, different market, different context, different flows. Don't try to say, well, if Wall Street goes down, cryptos can't go up, or whatever shit that is. Just try to make it easy on you guys. No fear of uncertainty and no lack of patience, okay? Just let it behave, and as long as these guys go up, as long as the context, H1 context, isn't reversed, okay? And even if it does reverse, it has to create a third range boundary afterwards and break it, okay? If there's a third range boundary and if it gets squeezed out to make new highs, well, that's just noise again, okay? We've seen that happening back then. It may happen again, all right? So wait for the market to create a very nice and steady third range boundary. As you can see, most of the time, third range boundaries in here have been squeezed out there and there. So this one could have been the same as well, all right? I just would like to say, don't try to overthink things. I think after this flow terminates, we're going to get the final consolidation that I was said back then, just the same one as we're in for the S&P 500 on lower time frames, okay? So the thing is, we're going to get to let 2 consolidative waves for the bears afterwards. You remember what I said on the low risk strategies. I definitely think that anyhow and anyway, we've got plenty of volume to put into the 29K to 25K area. Okay, sure, over the midterm, we'll get over the 30K level and the like, but how fast we do and go there isn't the thing you should pay attention to, all right? I know people right now are focused on the times. on the time series. Like I really say, if you flow trade, you're gonna have to embrace that uncertainty. And this is exactly why I wanted to make that lesson today. Okay, remind you of this. Even though all of these markets may trade for some of them on different times, on different time horizons, okay, even though they're all this, they all follow the same structures, you can see. But the output, like the true price movement, have nothing to do. From one asset to another, it's significantly different, all right? And it can sound endlessly complex if you try to make it any rational. It isn't and never will be. Just try to make it easy on you guys. It's just volatility on these time frames. The market makers will shift you one way or the other. They'll try to do everything they can to get you out of this game, okay? So this isn't what you do. Just flow trade. And remember that flow trading can only be done if and only if you figured out the low risk strategy first, all right? It's really crucially important for you to understand that lesson, all right? No flow trading if you haven't figured out the low risk strategy first, okay? That being said, I wish you guys a pleasant day. Try to be humble. Right now, it's all about volatility. And, well, I don't think it's the smartest and appropriate and most appropriate time to go bulk and go leverage positions and the like. I think more than ever, if you have bought the low risk strategies a few months back then, well, there's absolutely no reason to get scared. There is still upside flow potential. And then consolidation will eventually start to occur, but I don't nearly think that consolidation will be very profound. We'll see all about that. That being said, well, it's still bullish. The flows are still bullish. Let them play. Don't try to forecast how they will end. Just look for it. If you want to put some rational alerts, for example, now, and you know that the H1 time frame is pretty noisy, okay? So this alert triggering doesn't mean this is the end, but put some alerts on reversing context. That's something you can easily do. I've built those fucking indicators just because of this, to allow users to put some alerts, okay? So now that you know what you want to see, just put a goddamn alert, okay? So if you want, for example, the context to reverse, well, that's an easy fucking task to make. You can use either pro alerts if you want to set multiple conditions into a single alert, or you can just, easily do this. Like, for example, you set indicators, you're going to say alerts. All right, you're going to create a new alert. And you would say, for example, I want to be alerted whenever the prices are going below the context. Okay, so you would say, BTCUSD, crossing framework, context, support down. Though I want to know when the market is closing below the support context. That would be the sign that there are sufficient bearish forces appearing in the market to at least start to question the end of that flow. Until then, it just goes up. The bulls have force, and you would like not to fight against that. All right? Put that alert and make it easy on you guys. And you say, okay, look at H1 context, reversal to take profits on the forthcoming third range boundary. That's really the way it is, and don't make it any overcomplicated than that, okay? As you can see, the H1 time frame is already excessive, which is more than the same old sign that you should let it happen instead of fighting against it, and just, gosh, let it play out, all right? It can be excessive and it can last much longer than you think. Till then, bye guys.